I think people underappreciate how important it is to come up with a fixed set of rules, to come up with a system when trading actively or when investing in general. And the reason why this happens, I think, is relatively straightforward, because most people just get into investing through, for example, media attention, right? They hear about a certain asset class that is currently very hyped, where you might make a lot of money, or you might get a stock tip of somebody, and so you just decide, okay, let's put some money in this and see if it works out. And then it actually might work out, right? When there's a lot of hype around something, it might go up short term. And at that point in time, you might not really think about like a proper system. So what usually happens is, once you start making your first losses, that's then when you take a step back, when you actually think about how should I approach this in the future, that this doesn't happen again. And this current bear market in crypto and also in stocks might be a good chance to actually reflect on this. How can we avoid too many losses? How can we manage our risk? How can we time our positioning? And there's a lot of different levels to this, right? But the first and foremost level, on a broad scale, that's probably the most important, is simply diversification across asset classes. So I think diversification is understood in the wrong way. So for example, in crypto, people say, okay, you should not just own Bitcoin, or you should not just own this single altcoin because it might go to zero. But the problem is, within crypto, you've got a lot of correlation of different assets, right? So when Polygon Matic might go down, it's very likely that Avalanche during the same time goes down as well. It's very likely you will also see losses in Ethereum. So you're not really spreading your risk. You're not really diversifying, because the things, they go up and down at the same time. So in my opinion, what really diversification means is that you've got your capital in different asset classes, because the correlation tends to be lower across asset classes. So you want to have stocks, ideally not just tech stocks. If you've got a lot of crypto, that is relatively lowly correlated. You want to have property, ideally, if possible, not just in a single country, but in 2 different countries maybe. And when you get all of these things together, then the likelihood of all of these things imploding at the same time is relatively low. You might even consider having some money in gold and some money in cash. But of course, the expected return on those is relatively low, so this should be a relatively small allocation. But you want to do this, right, as a base. You want to definitely allocate across different asset classes. And when I just looked at different polls that I made within the audience here, I've seen that many people are just mainly focusing on crypto. And it makes sense, right? It's a not yet so mature market. It's got all of the volatility. It's got all of the opportunity as well. So when you time it right, crypto is probably the best place to be. That being said, nobody is right 100% of the time, right? And if you're just wrong one time, then you might lose so much capital that it's very hard to recoup all of that capital. Which, when you're young, isn't really a problem, because your regular income might be relatively high compared to the wealth that you've accumulated. But the older you get, the fraction, the relation of your regular cash flows versus the money you have saved up is getting smaller, right? So when you've got a large loss in your wealth, you take longer and longer in order to just catch up again through simple savings. So that's why risk mitigation, diversification becomes more and more important over time. It's important to learn about this. And the earlier this is learned, the better, right? You don't want to learn that it's bad to lose 80% of your capital if you've already got 10 years of savings on the side. So diversification is a main point. The second point is, you should then think about, that's how I approach this, you should think about the maximum volatility that you're willing to endure psychologically, mainly it's psychologically. So you want to think about, is it okay if I lose 50% of my wealth temporarily if we are in a bear market? Or do I only want to endure, say, 30% or 20%? So when you're relatively young, that's mainly a psychological thing. So say you've got 2 years of income saved up. Are you okay when this splits suddenly to 1 year? Or are you even okay if it just splits to half a year, right, of income? That 2 years of income saved up suddenly becomes just half a year. Are you okay with that kind of volatility? Are you okay to continue to invest? So that's one point. Then you might also consider, do you have actually any larger expenses that maybe for a down payment on a house, you're planning to build a house? Can you risk it? Can you risk that volatility with that regard? And then, of course, as you grow older, you might consider things such as retirement, right? Is it really cool to have a 75% drawdown if you're close to retirement and you can't really, again, save enough? So you have to think about risk tolerance around volatility, and based on that, it then makes sense to think about how heavy should you be across those different asset classes in terms of risk, right? So when you can take this 75% drop, then it's okay to be, say, even 50% in crypto, right? And to have a lot of exposure to Bitcoin and maybe to a few select altcoins. If you can't endure this, you have to be realistic about this. Even without ever having gone through this process, you have to really try to have the self-awareness to imagine yourself in that scenario. If you can't, then make sure that you do have quite a bit of money in stocks, ideally in an ETF that's also broadly diversified, where you don't have a lot of idiosyncratic risk in a single stock. So think about that, and think about probably property as well. Maybe not even that highly levered, maybe relatively safe property, right? There's non-safe and safer property. There's property that moves more, where there's more speculation. For example, in Hong Kong, there's a lot of speculation around property, a lot of leverage. Those houses or apartments go up and down more with the market than maybe a farm somewhere, probably. So that's basically how I would think about this first and foremost. Now, this does not mean that investing has to be completely boring, right? And you just allocate once and you forget about it. Because especially when we are all young, we want to take our shots, right? We want to take opportunity off the market. And if we especially think we have an edge in something, that's very important. I think you've got an edge. You have so much knowledge about a particular market. You've studied your local property market, or you really dove really deep into the smart contract of a particular altcoin, or you really know the team very well, you know the marketing around some particular altcoin. You think you're better informed than the average. Then it does make sense to try to monetize that edge, right, over the general populace. And you should then also expect, when you are better informed, to outperform over the long term and to generate alpha, so to speak. But it's important when doing this to again do this with a planned size. So you have then a particular fraction of your portfolio that's maybe fixed, that's maybe 20% or whatever it is, that you just use for active speculation. And then even within that active speculation part, you don't bet the whole portfolio just on a single bet, right? Because even though you might be right 80% of the time, if during those other 20% of the time, which by the way is a huge win ratio, right? But let's say you were that good, if in those other 20% of the time you would suddenly lose almost everything, then you can't recover again, right? So even during concentrated short-term speculative bets, where we try to take opportunity, we try to capture alpha, we have to do this in a planned way. And it takes quite a bit of time to come up with something where you individually feel comfortable around things. And sometimes the target allocations for, let's say, this is my crypto allocation, this is my property allocation, etc., these might even shift because of different market outlooks, right? For example, now crypto is so low, it might make sense to be overweight on crypto versus other asset classes. So these things might shift, and still it's good to have some kind of a framework around this, to have some kind of a fixed rule around this to rebalance when things go up. Because when you don't have a system, then you make all these mistakes. You suddenly bet too much on a single bet. And even though you were relatively safe around this, you suddenly got a random hack around your altcoin that you knew everything about, and you lost everything. Or whatever the black swan event is that's currently the flavor of the day, right? You can easily get knocked out. So risk mitigation comes first, not losing comes first, and capturing opportunities, generating alpha is still important, but it should not come at the expense of getting completely broke. And I think it's even important, even if you're young, to kind of get this framework set up correctly, even though you could afford to lose it all, simply just to get in the rhythm to not do this mistake in the future. Because there's a lot of people that got once, that made a lot of money once and that then lost it all again, simply because all of the risk taking took them up there, but it also then brought them back down. So there was no real system around this. And bear markets like this are a good opportunity to actually sit down and really think about this and set something up that you can then follow, that the short-term emotions are not going to guide all the things, all the investment decisions you make. Because sometimes the gut feeling can be, especially investing, can be really, really wrong. When crypto is going up, crypto looks great and you want to allocate more than is healthy, and vice versa, right? When crypto is now going down, there's no attention on crypto. There's no new people entering this space, right? When we look at new subscribers for YouTube channels, etc., all the crypto channels are basically now in hibernation mode. There's no new people entering. There's only existing people watching. And so during this time, it makes sense to get this all properly set up and be contrarian and buy when the people that are just in there for the short haul they sell. You want to be against the general market or against the general masses over the very, very long term, and you want to dollar cost average in when it's not fancy. Right? When I first started dollar cost averaging into Bitcoin, which was in the middle of 2018, Bitcoin went from 20K to 7.5K. So I started DCAing in at 7.5K. I bought and bought and bought, and then even continued buying after we dropped to 3.5K. During that time, I didn't tell anyone that I bought crypto because it was simply not fancy. When you then told somebody that you bought Bitcoin, people would think you would throw your money away, right? Bitcoin would be going to zero, it wouldn't go anywhere. So talking about crypto now during this time is not fashionable. And especially the people that lost now or that saw other people losing money, they will be the ones that might ridicule you for buying. And so there's not really a lot of benefit in shouting this all out. And this goes then the exact opposite way as well, right? When things are going up and you're telling people that you're selling, you get a lot of bashing for this. I made a video in, I think it was May of last year, when I sold half my Bitcoin holdings at around 51K or so it was. So we peaked at 60K and then we went down to 51 and I sold, then it went up again to 55 or so, and then it went really, really down. So I made that video when I sold quite a bit, and the comments on that section, on that video were very, very pretty hostile. So you never get, especially during extreme market conditions, you never really get praise for being against the general sentiment. But this is, funnily enough, the right move at that particular point in time. And so now it's not fashionable to buy, so you should be buying. So in that way, it's kind of interesting, right? We have this deep down inside, we've got this herd mentality, and over the short and medium term, following the trend also makes sense. And so these trends, they compound for a while until they reach the saturation point where they suddenly turn around. If you have a longer term time horizon, very often you have to do what's currently not fashionable. So it's the independent person that's not too much carried away by all the hype or by all the negativity that then comes out as one of the few winners, right? Not everybody can be outperforming. It's a small minority that outperforms. And so that small minority does something different than the masses. And that's simply how we have to see this. Set up your system, allocate wisely, that you can shift between one asset class to another asset class. Maybe now it has already been somewhat too late, because probably now, if you haven't yet allocated enough to something else than crypto, this drop lost you so much money that you don't actually have a lot of other asset capital that you can just move into crypto and just use your regular cash flows, right? But in the future, that can then be an opportunity to actually shift across asset classes if you've got something properly set up, a proper set of rules with target allocations, target volatility, maximum drawdowns. And then when Bitcoin suddenly grows again, when it suddenly goes again to 40K, and your target allocation is maybe 10%, you allocated 10% of your wealth to crypto, suddenly Bitcoin doubles. Now suddenly you've got 20% of your wealth in crypto. At that point in time, you will know, okay, I've now got my system set up. I will take some profits, and I might move that money into something else, not necessarily cash, right? But maybe put this into crypto, or maybe take the money out for a down payment on a house, whatever it is. That way, wealth can build over time, and the fluctuations, because of the low correlation across asset classes, can help mitigate risk, right? That's the most important thing. Don't diversify within the asset class. Don't try to diversify your Apple stock with holdings in Google and Microsoft, but rather diversify your Apple holdings with a small apartment in a city, or a purchase of a altcoin that you are bullish on. That's what I think makes more sense to get the best risk versus reward over the long term. Okay, I hope that video was useful. Probably you're just a regular subscriber anyway, so I don't even ask for subscribing. If you could give this a thumbs up and give me some feedback if you like this kind of video format, let me know. It's a bit different to what I usually do. So thanks again for watching. And of course, there's also a similar video that I will now link here. I guess over here, where I also made a similar kind of monologue talk. So I hope to see you in that video as well. Thanks, and see you over there. Bye bye.